Quantitative easing sounds complicated, but it's at the heart of how the Federal Reserve, America's central bank, influences our economy. In simple terms, it means the Fed creates new money electronically and uses it to buy bonds, mostly from the government. This pumps money into the financial system, aiming to lower interest rates and encourage borrowing and spending. The idea is to stimulate the economy, boost growth, and prevent deflation. But what happens when this easy money policy becomes the norm, as it has in recent years? This is the core question explored in The Lords of Easy Money. The book argues that while quantitative easing can provide a short-term boost, its long-term effects are more complex and often detrimental. By making borrowing cheaper, it can lead to excessive risk-taking by investors and businesses, inflating asset bubbles in the stock market and real estate. This creates an illusion of wealth that benefits the wealthy, who hold most of these assets while leaving average Americans behind. The Federal Reserve has the power to create money out of thin air. This might sound like something out of a fantasy novel, but it's a fundamental part of our modern financial system. When the Fed buys bonds, it essentially injects new money into the economy. This increases the money supply, which can lead to inflation if the economy is already running at full capacity. Think of it like this: if there's more money chasing the same amount of goods and services, prices will naturally rise. This is the most direct way the Fed's policies impact your wallet. The book argues that the Fed's reliance on quantitative easing has created a dangerous dependence on cheap money, making it harder to raise interest rates without causing economic shocks. This limits the Fed's ability to respond effectively to future crises. The impact of the Fed's policies can be seen in the struggles of everyday Americans. One of the most concerning consequences is rising income inequality. When asset prices inflate due to easy money, it primarily benefits the wealthy who own those assets. Meanwhile, wages for the average worker haven't kept pace with the rising cost of living, fueled by inflation. This creates a widening gap between the rich and the poor. Another issue is the growing burden of debt. Low interest rates may seem appealing, but they encourage borrowing, leading to higher levels of personal and national debt. This can create a fragile economic environment vulnerable to shocks. The book highlights these real-world examples to show how abstract monetary policy has tangible consequences for ordinary people. The Lords of Easy Money centers around the dissenting voice of Thomas Honig, a former president of the Federal Reserve Bank of Kansas City. Honig emerges as a voice of caution amidst a culture of complacency within the Fed. He argues that the Fed's policies, while well-intentioned, create long-term risks that outweigh the short-term benefits. He warns of asset bubbles, inflation, and a weakening of the dollar. Honig's concerns were largely ignored during his time at the Fed, but the book argues that his warnings are more relevant than ever. His story serves as a reminder that even within powerful institutions, dissenting voices are crucial for balanced decision-making. So, what can you do in the face of these complex economic forces? While you can't control the Fed, you can take steps to protect your financial well-being. Start by creating a budget and sticking to it. This will help you manage your spending and avoid accumulating unnecessary debt. Consider paying down high-interest debt, like credit cards, as quickly as possible. Explore investment options to grow your savings and combat the erosive effects of inflation. The book encourages readers to be proactive about their finances and not rely solely on government policies or the whims of the market. By taking control of your financial decisions, you can navigate the uncertainties of the economy with greater confidence.